When you hear the Fed just increased interest rates, it's important to understand that we're not talking about mortgage rates. They're referring to the Fed's short-term benchmark rate, the federal funds rate. Now, the federal funds rate is used by banks when they borrow amongst each other, but it's also used to calculate the prime rate. Prime rate is used for credit card debt, auto loans, small business debt, basically short-term debt. Mortgage rates are based on supply and demand of longer-term bonds, mortgage-backed securities, of future economic forecast. Mortgage rates and the Fed's decision to increase or lower the federal funds rate are based on economic conditions, but they are very different. Now, on Wednesday, everyone knew ahead of time the Fed was going to announce their 25 basis point increase to their federal funds rate. It was no surprise. It had been built into mortgage rates weeks ago. The markets were waiting for Powell's 2:30 press conference. What would he say and how would he deliver it? Would he talk about inflation having turned a corner based on the last CPI report? Would he talk about a potential end to the rate hike cycle? What clues, what hints would he give about future monetary policy? Now, Powell said very little. He did acknowledge inflation was trending lower, but did say that he felt it wouldn't be appropriate to end future rate hikes, that any decisions will be based on incoming economic data confirming that inflation is moving closer to their 2% target. Now, this incoming economic data is exactly why we got hurt on Thursday. Jobless claims, durable goods, the advanced reading of second quarter GDP all came in stronger than forecasted, an indication of economic strength, of resilience. Bonds unfortunately weakened, and we did lose ground across mortgages. Now, on Friday, we had PCE. This is the personal consumption expenditure. This is the Fed's favorite inflation metric. Did come in slightly lower than forecast, so it was certainly good. Now, not enough, unfortunately, to erase Thursday's losses, but it was definitely good to close out the week in the green. So definitely a good sign. Now, next week, we have the upcoming jobs report. It's the biggest piece of labor market and wage data each month. There's also a slew of other economic reports, and I'm sure a table full of speeches from Fed presidents who are going to comment on last week's Fed meeting. If you have any questions about these headlines, about these new rate trends, or if you want to talk about how they impact you and your purchase power, give me a call. This is Billy.Saylor, your mortgage professor, 571-330-5884. Have a great week.